So I think we can start. For the first question, what we wanted to do was set in context our audience. Some of them might be, they already know the tax equity financing and the concepts or the variables involved with this topic. But for those who are not very familiar to it, we wanted to provide a starting point for them. Is there anything else you might want to add on top of what you already shared on the document?
I think the important thing to understand is that the government has, for many years, decided that this particular form of industrial policy, because that's really what tax equity is, something that it's going to allocate through certain channels. And so what it's going to do, and what it does, is it allocates a portion of the tax revenues that would ordinarily go to the government to these desirable forms of investment. And it does that by reducing the tax liabilities of those who participate in these projects. The reason that tax equity financing grew up was because most of the developers who want to benefit in forming their capital structure from tax equity don't necessarily have sufficient tax liability in the first place for them to be able to reduce it with the tax incentives, the tax credits, the depreciation that the government is prepared to allocate. So they have to partner with entities that do have sufficient tax liability to do that. And that has often been large banks, large corporations, and in particular, the reason that banks have dominated that particular business is because they have the skills to underwrite the project risks, to understand them, to underwrite them, and they have the tax bill that they can mitigate with the tax incentives that come with the projects. So that's how the banks came to be such a big part of the tax equity world. And the reason that it ended up being called tax equity is really because these benefits are benefits that are supposed to accrue to the owners, to the equity owners in a project. And yet the banks themselves don't really want to be equity owners. They want to have an enhanced position in the capital structure, and they really want to be lenders. So a lot of effort goes into structuring these deals to make them look and feel like equity as far as the tax code is concerned, but really to give the providers of that capital a preferred position in the capital structure.
Great. And I think that's a perfect follow-up for the second question. Given these larger institutions involved in this arena, from an outside perspective, it feels like it's very hard to have a more flexible approach, or some other opportunities for many of these companies could have like different stages, different business formats, whatever. But seems like given the banks and these big financial institutions are like the owners for that part, could be the ones that lead how this tax equity structure should be. But that also opens the possibility for other companies or other entities that could participate. So that is what we're trying to deep dive in this second question, trying to understand like how could setting apart like those big players, what other opportunities could be out there.
Yeah, you're right to say that these structures by which banks have come to participate do feel like they're needlessly complex. The complexity is driven by the tax constraints that all the parties have to respect in order to get the outcomes that they need. And the structures are a compromise between an elegant way of making sure that each party gets what it wants from the structure, at the same time as ensuring that the rules and regulations of the tax code are met. There are a few different ways that these deals can be done. Traditionally, there was a structure called sale and leaseback, where the developer would sell their project to a tax-based investor who would then, as owner, take the tax benefits and pass them through to the develop it in the form of an attractive lease finance rate. But the structures contain the requirement that the project be bought back at some point in the future at its fair market value. And that meant that after the tax benefits had disappeared, that the developer would potentially have to pay a lot of money to get that project back. So the partnership flip structure was designed to enable that shift in ownership back to the developer to take place without the need for there to be a substantial buyout. It's not straightforward because the typical means by which these deals work is that the parties agree on a target rate for the tax-based investor. Let's say it's 8%, 8.5% after tax. And after that hurdle has been reached by a combination of cash and tax benefits, then the economics flip in a different direction back to the developer. So it might be 99.1 of tax going to the tax-based investor for the first 5 years, and then after their hurdle has been achieved, it flips. And at that point, the tax equity would expect to be bought out for a smaller amount than would have been the case for a sale leaseback. So that is a structure that worked and still works for a long time. But when the Inflation Reduction Act came along and set up another way for transferring a portion of the tax benefits, those were possible and in fact grew the market substantially. And I know we can get into that in more detail, but it did work and the market did grow substantially. So I think there was a sense that there needed to be some way of opening up the universe of investors who could get involved in these projects and not constraining that universe of investors by those who could underwrite and take project risk. The goal was to develop a means of simply transferring the tax benefits in a way which everybody knew the IRS was comfortable with, and allowing it to be a simpler investment case for the purchasers of those credits.
Yeah, and I think that unlocking this potential, lowering down complexity, it's a great opportunity for many of the entities participating, also like the group you're leading. But maybe something that could complement that bright side of having that growth would be learning more about the potential risks when the market starts growing and there are more entities that could benefit from this strategy. Does that also bring like a side effect or some risks that might be considered for, or we need to discuss in this space?
I think there are trade-offs clearly, because if you implement, which has happened, a system of transferable tax credits, it is exactly that. It's a transferable tax credit. The tax credit is not all of the tax benefit that comes from a deal. There are primarily two kinds of benefits that come from a deal. The first is the tax credits, whether it be production tax credits that are produced every year, or an investment tax credit that occurs at the outset and is based on the capital value of the project. But there's also depreciation or accelerated depreciation. So depreciation is different in as much as it's a timing benefit. So accelerated depreciation accelerates the write-off of the capital value of a project into the earlier years. So if a project's depreciable life is, let's say, 10 years, you might be able to accelerate the depreciation into a 5-year period. And what that means is you get the tax benefit, the write-off, the tax shelter of the loss that's inherent in the depreciation. The tax-based investor gets that quickly, and so they get that cash back quickly. And it ultimately turns around, because when the investor is bought out of the project, then they'll recapture the loss that they took in part through a capital gain that's realized on the sale back of that project. But there's a time value of money. So that's another benefit. And in investment return terms, that can increase the IRR on a project. significantly. So tax credit transfers don't transfer that benefit. That stays where it is. The trade-off in this case is that a developer is able easily to transfer the credit to a larger universe of potential buyers, so corporations who don't necessarily have the skills to evaluate project risks and don't want to take the risk of future cash flows. They just want to buy the credits and then move on. But those transfer deals don't transfer the depreciation benefit to the tax credit buyer. So that is left where it is. So you either have to bring in somebody else who can benefit from that depreciation and pass that benefit through to the developer, or the developer themselves will have to be able to take that benefit over time. So that's a trade-off, and it's a trade-off, but nevertheless, the market grew. It doubled 24 from, let's say, 20 billion of tax credits transferred through tax equity deals to 40 billion of total credits transferred, roughly 50-50 between tax credit transfers and tax equity deals.
Yeah, that we can infer that trade-off is worth for investors if the market doubled, considering this part. Do you think investors in general are aware of these trade-offs, or what could be potential barriers for people to adopt tax equity as part of their strategy? Some of the common misconceptions that you've heard or faced during your career that you think that could be harming in the future this particular concept?
I think it's a good structure. I think when it was introduced, I thought what it would do is, what in fact it has done, is broaden the market for people to invest in the clean energy space. And it's definitely done that. I think it's almost acted in the same way as the introduction of securitization acted to broaden the universe of investors. When the mortgage-backed security was invented, it chopped up the cash flows of a mortgage into multiple tranches that were then sold to people who had different appetite for the shorter term, the longer term. And so it sliced it up to enable it to be distributed to people who were able to get like a menu of options and choose from them. And it's done a little bit of the same thing in the clean energy market by saying, all right, there are people who want to buy the tax credits. There are people who want the depreciation. There are people who want the cash flows from the project. Let's make it possible for each of those parties, who may be a different party, to get what they want without one party having to take it all and then suboptimally price some piece of that puzzle. And what's happened now is you have a number of different kinds of structures that have evolved. There's a traditional tax equity, which still continues. There's the tax equity, which is essentially the same participants, but with the ability to transfer out the tax credit. So let's imagine a bank who invests in a partnership flip transaction in a traditional way, but instead of keeping the tax credits and the depreciation and a portion of the cash flows, they separate it out. They sell some or all of the tax credits that they get, and they sell that to a corporate client, for example, and they keep the depreciation, and the developer is essentially in a position where their bank partner is able to do more deals with them, because if a bank enters into a partnership tax equity deal and they're taking an investment tax credit, that can be a very substantial amount of their tax capacity that they have to commit to that one deal. And so it can limit the number of deals that they can do with that developer. So their ability to transfer that tax credit and just that tax credit to a corporate buyer enhances their ability to participate in more projects with their developer clients. In that way, tax transferability has created more flexibility. It also creates the opportunity for a structure where, for example, a non-traditional tax equity buyer can participate in a different way. Let's say a private credit fund that ordinarily would not have the ability to participate in a tax equity deal because they don't have tax capacity, right? They're passing through all of their taxable income or tax deductions to their limited partner investors. And so they couldn't traditionally play. But in this case, what they can now do is to provide a substantial amount of capital in the form of preferred stock. They can contribute that to a transaction, enter into a partnership with a developer, and the developer and the private credit can divide up depreciation, which takes a lot less tax capacity, between them, and they can transfer the tax credit, which is the harder part to absorb if you are a private credit investor. They can transfer that tax credit to a corporation that does have the tax capacity to absorb it, but doesn't want to stay in the transaction for any longer than it takes to get the tax credit. So that structure has evolved. And in all of these cases, when the developer transfers their asset into a partnership, they get a benefit just from doing that. And let me tell you how that works. If they build a project at a cost of let's say 100, ordinarily that 100 would provide the basis on which the tax credit is calculated. So if there's a 30% tax credit and it's 100, they would ordinarily get a tax credit of 30. Determine on completion that project is actually worth 150. In other words, they've increased the value at completion. They can transfer that project into a partnership with a third party, an arm's length transaction, and now the basis for that tax credit calculation is 150. So actually they'll get a tax credit of 45, whereas before they would have got a tax credit of 30. So the presence of a third party in that structure enables everybody to benefit from an enhanced tax credit level. And that has to be credentialed by an appraiser, and it has to be a valid arm's length transaction. But that's the potential. So that opportunity has always existed and still exists, provided you structure the deal properly.
Great. Yeah, I think complementing that part from specifically from the renewable energy landscape that you were mentioning, we've seen and actually we're working on a piece which is a report that analyzes trends, macro environment, and many other things that are happening in the private investing landscape. And we see that common, especially in the US, that there's some other factors, political factors, that are harming the conversation about ESG, for example. But at the end, probably the DAC or the name is the one that is getting like the harm. But at the end, the core, that is not something that should be struggling with. The core concept of what ESG represents, for example, talking about renewable energies, could be on the same line as a couple of years ago. It's more about the conversation and some specific tags or names that could be getting into a political conversation. How do you see that from your perspective? Like you see it like these opportunities will continue? Do you think at some point could also be harm, or as a few months could probably one heard about the ESG bubble, that it was something that was about to burst, but probably from my perspective, it is not a reality. Do you think that will have an impact on the short term?
I think there are a couple of different aspects to that question. The first is ESG, and is ESG a good investment framework? And I think that certainly came under a lot of scrutiny. I think it was even before the new administration arrived. I think that the ESG focus to investing had begun to lose some of its attractiveness, because anything that structures an investment based on non-economic factors is going to struggle over time if investors can't see the returns coming from it. And in part, that's a question of developing benchmarks by which you can measure returns, pricing carbon as an attribute that if you avoid it, you can get some economic benefit from it. So I think ESG investing as such struggles to deliver returns. And I think the other aspect of that is as soon as you create industrial policy through tax policy, then you have competing considerations. Because as you see right now in the legislation that is being moved through Congress, particularly the House reconciliation bill that's going to go for consideration by the full House before Memorial Day, has taken some significant swipes at the Inflation Reduction Act. The Inflation Reduction Act, I think, was a little bit tainted from the point of view of this administration by being a product of the ESG world. They call it the Green New Scam, right? And so if you have a scam, then you want to end it, right? So you describe something as being a scam for the purposes of undoing it. And so what you've seen is in this bill is some significant steps taken to reduce the tax credits that are available from clean energy projects. And so that we'll see how that turns out, but there is definitely going to be some reduction in the tax available. And why is that? The priority of this administration is to make permanent the existing level of tax rates for individual investors that was put in place with the Tax Cut and Jobs Act of 2017, and that the president always promised would be extended and made permanent if he were to be elected again. So there's a price tag on that of around $4.5 trillion. If the priority is to deliver, that has to be paid for, because we already have more debt than we would like at 36 trillion and counting. And if you reduce taxes, there's only certain revenue sources that a government has, and the primary one is tax revenues from corporations and individuals and excise taxes and, of course, tariffs. There is definitely a risk. So, for example, what was targeted in yesterday's draft was home-based tax incentives for solar and batteries. That particular credit is targeted for being sunsetted at the end of this year now. And another one is credits for electric vehicles. That credit has been targeted to be sunset at the end of this year. And the availability of certain other tax credits has been trimmed by reducing the final year of eligibility. So let's say from 2032 to 2031. There's also a move to reduce the time window during which tax credit transfers can take place. And so those are some of the threats that have now been clarified. It's not clear that they'll end up being part of legislation that is passed, because what happens with industrial policy is that it confers benefits, it creates jobs in the locations where the projects are built, and a lot of those jobs and projects have been constructed in locations that are red states. There's a good reason for that. Often permitting and land use is easier in those states. Compare building a project in Florida or Georgia or Alabama to building one in California or New York. It's easier in those red states. So a lot of Republican Congress people have said, hey, don't be so eager to take away these benefits. Our constituents have benefited from those projects, so we're not so keen on you removing those benefits. So we'll see how that works, but it's always going to be the case whenever you create tax benefits and tax incentives, mouths to feed from the same trough. And depending on who has the power of the legislative pen at any one point in time, particular constituencies will have more power to get their share than others.
Got it. I think that the final question was very related to that point. I was referring to the short term, but you also talk about midterm. Without trying to put you in the spot or thinking that you have this crystal ball, how do you feel and think this could evolve with all the variables you're mentioning, the political one, the environmental one, because we are also rushing to get more new technologies, more solutions. The demand is growing because of the reality that we're facing. So how do you envision that this tax credit could evolve given all these circumstances that you mentioned for the longer term?
I think it's interesting. One of the things that people usually criticize industrial policy for is that it says governments are not the best people to be picking winners and losers, that you should let the market pick winners and losers, not the government. But when it comes to allocating tax benefits, the government is doing precisely that. It's picking winners and losers to whom it's allocating tax benefits. And it's going to do that with this legislation. There is going to be some restructuring of the Inflation Reduction Act benefits as a result of what comes out of this Congress. And that's okay. That's fine. That's just the way it goes. And I think we're beginning to see the direction of this, which is, I think, electric vehicles, home residential solar systems are probably going to see a reduction in benefits of some sort. Electric vehicle charging infrastructure probably will not see such a marked reduction in benefits, because I think you don't want to strand an existing base of vehicles from its ability to move around the country and charge up. It's taking out gas stations.
Yeah,
that's not a good thing. So I think that will happen. I think there'll be some reduction in the time window that is available for these credits to be awarded. So I think a lot of people understood that the Inflation Reduction Act had put a time frame on the availability of credits of, let's say, 10 years for scoring purposes. But the mechanisms that they put in place for those benefits to sunset were such that, in fact, they would continue for longer than that period of time. And I think the fact that the credits are not limited, right? They were scored at 369 billion in the Inflation Reduction Act, but there was no actual limit. You know, if people built projects sufficient to absorb $1 trillion in tax credits, there was nothing in the legislation to stop that. So I think that's going to change. And I think we'll see some redistribution of benefits. So, for example, the House bill that was published yesterday proposed increasing the time window during which the 45Z or clean fuel credit is available. And that's a credit that, you know, from all sorts of different sources, farms, renewable natural gas, biofuels, those create emissions. And then a credit exists for those who can take those emissions, clean them up, and reprocess them into transportation fuel, such as compressed natural gas. And the government created an incentive for that to happen. And it was time limited to a relatively short period. And that period has been proposed to be extended. So I think that's a redistribution of credits. And I think there will be some of that takes place. I don't see that the whole regime of Inflation Reduction Act incentives is going to be taken away. We saw how hard it was to take away the Affordable Care Act benefits when they were granted. People like those benefits. So I would say there will be changes. There will be reduction of certain credits, redistribution of those credits to different sources, and I think more of an impetus to emphasize an all of the above kind of approach, where we're not just pursuing, you know, renewable energy for the sake of renewable energy. We're trying to have abundant energy sources to fuel data centers that we need, to fuel the AI that we need, to increase the productivity that we need, to be able to reshore manufacturing and have a competitive product produced. So I think that's how I see it happening. Having spent so many years in businesses that rely on tax benefits to increase returns from projects, seeing the ebbs and flows of tax bills and incentives and cutbacks and so on is not new. It's always been this way, and it will continue this way. But I'm optimistic that energy will continue to be a focus, and that incentives for building energy projects will continue.
That's great. I think if you're optimistic about it, that makes me more optimistic. And that's it. That's the whole questionnaire from our end. Is there anything else you think will be valuable for our community to learn?
I think I would say this has been a sort of a great Q&A about tax equity and tax credit transfers and the Inflation Reduction Act. There's obviously a lot more detail that exists behind this level of detail. And so I would encourage anybody who wants to dig into this more, that they should reach out to me at Dakota Ridge Capital. They can book a call with me. I know you'll put links in your resources, but I love helping people figure out how to find their way through this, what appears to be a complex maze of constraints to get to where they need to. So I would definitely encourage people to do that.
That's right. We make sure to include this as part of the content, because I think from our end, what we're trying to do is push some specific topics or conversations around. Publishing this is just like tip of the mountain. There's a lot of things that need to be covered, and that's why we can pass the conversation towards you and your team.
Great. Okay. This is great. I think you're doing a real public service here, and I'm happy to support it. So thank you.
Thank you for the time, the explanation, so detailed. It was very interesting having this conversation with you. We only have studied like the surface of this. Talking with you, it has been very interesting. So thanks again.